Today's resource person, Madam CA, Dr. Dibya Abhishek, and my dear beloved, December 2021 term qualified cost accountant and few pursuing finance bench also. On behalf of ICI Bhubaneswar chapter, I welcome you all to today's webinar, the financial modeling. And before going through the topic, I would like to brief something about the today's resource person, Dibya Abhishek Madam. Just a minute, sir. Dibya Abhishek Madam is a practicing chartered accountant basically from Chennai. She has completed her cost accountancy, chartered accountancy, and company secretary with the All India rank. With the All India rank 4th in the international taxation examination conducted by CIOT UK, along with diploma in IFRS with ACCA London. She has qualified in the proficiency for independent directors conducted by the Indian Institute of Corporate Affairs. She has the distinction of being the first Secretary Business Development and Trade Relations to the Honorary Council of Zambian, South India. She has addressed over 800 conferences organized by the corporate forums, professional bodies, Chamber of Commerce, university, and college. She has co-authored a book on income tax ready referential. Madam has held various positions in the Southern India Regional Council of the Institute of Chartered Accountants of India in Corporate Law and Allied Laws. She is in the advisory committee for SSS Jain College and SDNB Vaishnava College and a visiting professor at Madras University. She has also spearheaded in committees for women empowerment for Hindustan Chamber of Commerce, Women Empowerment Forum of India, and Inner Wheel Club of Madras Next Gen. She is also the mentor and co-founder of the Twice Treasured, which is a platform promoting sustainability for pre-loved baby products and has over 70,000 users within a span of 1 year. Thank you, Madam, for acceptance of our invitation. Hope this session will sharpen the knowledge of all young CMAs. Thanking you all. Jai Jagannath. Now I request Madam to address this.
Thank you, Biswal sir. Thank you so much for having me here. It's always a pleasure to speak at my alma mater, CMA Institute, and also address these bright minds. A very good evening to all of you. I hope all of you have had a great day. I want to start off by congratulating all of you. It is not easy to clear such a prestigious, difficult professional course, and you'll only be making us prouder as you go conquer the world here from today. Now, today's topic is about financial modeling. Friends, please remember this session is not going to be a one-way session where I'm just going to be addressing all of you, but we're going to have a lot of discussion because I believe true learning comes from discussion more than listening. So please be interactive. Use the chat box. Like I said, there's no right or wrong answer. The very fact that you've finished your CMA means you're already smart enough. So please open out and respond in the chat box. Now, before we get into the hardcore of what financial modeling is, I first want to take you through the financial statements. Now, you might be wondering why it is so basic. What is Madam doing talking about financial statements? You will understand why we're doing this at the start over the course of the session, the 1-hour session today. Now, as you know, financial statements as profit and loss, balance sheet, cash flow, change of equity, notes. Whenever someone says financial statements, it's going to be a bundle of all of these together. Before I start the session today, as you can all see in the screen, there are 3 options. Now, I want you to take quick 30 seconds and put in the chat box as to which option you think is the best according to you. If I show you this financial statements, which option will you be picking? You can just say option A, B, C, whichever. And if you want, you can also provide me why you think that option is the best option. A quick 30 seconds and then we can discuss it further. You can just start typing in the chat box as to what you feel is the best option, friends. I'm going to wait until I get at least 5 answers before I move on to the next slide. So even if you feel it's a right or wrong, just type A, B, or C. What you think is the best option. Yes, friends? Can we start typing out what we think is the best option? Okay, thank you, Avinash. You've said B. Ankit has said C. Vivek has said B. Another one with option C. B. And for those who are picking either of the option, yeah, thanks, Jyoti. Can you also give me a reason as to why you're picking that option? It will help us analyze this case better. Deepak has said B. Another 5 seconds and we move to the answers. Okay. Anyone else? Okay, thank you, Bapni. A lot of you have already picked the right option. So now I'm going to move to the next slide so we can analyze why we have picked the option. Now, option B is a better option. So whenever we look into a financial statement, you should always go through the elimination method, where if you see option A has a high goodwill and high inventory. Now, neither of this is good because goodwill has no value when you're going to sell your subsidiary. If you take inventories, a high inventory means that you have excess stock that you're not able to sell out. Generally, inventory will only be 7 days worth stock. It cannot be a substantially high number. The other option C that some of you have picked, while option C also has a good balance sheet, what primarily has to hit your eye is this current asset to fixed asset ratio. Fixed asset is very low in this case, which means current asset by nature we know has only a 12-month inventory cycle, right? It's very temporary in nature. So always go in for the option which has a higher fixed assets and a good current asset, current liability ratio, which we will go through again as we go through this course. Now that we have seen the asset side of the balance sheet, the next you see here is the liability side of the balance sheet. Now I want you to again do the same exercise and tell me which option in your view is better, whether A, B, or C. You can take a minute or 30 seconds and then give me your answers. And whoever's telling me the option, if you can also say why you picked that option, will be extremely helpful. Yeah, can we start? Okay. Option A from a lot of you. Anyone else? And for those, I think someone has raised a hand. I'll take up all your questions at the end of the session. I'll ensure I leave time for it and take it up. Option A seems right, but still, says Jyoti. Diksha says A. Anybody else? Okay. Okay. Borrowings are less adequate reserves. Okay. Anyone else wants to tell me which option is good? Okay, so let's look at which option is good. Almost all of you got it right. Option A is better. The reasons being, if you take option B, the borrowing is slightly higher than it should be, and you have a high trade payable, which is not good because tomorrow it's almost equal to borrowings, correct? So there is high liability and debt for the company. If you take option C, straight up, you have a negative reserves, which shows the health of the balance sheet, even though overall it's still at 68,000 and trade payables is still high. So while assessing a financial statement might sound very basic to qualified like all of us, what is important is it forms the bedrock of what we call as financial modeling. Friends, when I first heard the word financial modeling in my articleship days, I also used to really worry, thinking it's a very niche field, we cannot understand it easily. But the more we learn, the more practical exposure we have, it's one of the most interesting fields, which is why it was felt fit to have this as a part of campus placement, to equip all of you and to ensure that all of you are more open to this chapter. Now, what is financial modeling? In very simple terms, it is going to help you to make decisions. Basically, with what you've already seen, that balance sheet, you will forecast a little more with use of simple tools, and you arrive at a value for the organization. In very layman terms, this is financial modeling. Over the course, I will take you through how you do it, what roles you can apply for if you have interest in this chapter. Now, does a business use financial modeling regularly? What do you think? Yes or no? Do you think a business uses financial modeling almost on an everyday basis? Or you think it's more a specific aspect where you don't use it regularly, but when you have acquisitions, at that point of time, there's a merger, that's when you use this financial modeling. Please tell me your view, friends. You can use the chat box, and I don't think this should take so much time. You can just say yes or no. So Jyoti says yes. Anybody else? Do you think businesses use financial modeling very often? Okay. So absolutely right. Both Bapuni and Jyoti and Anisha, Prakta, almost all of you. So businesses uses financial modeling almost on a monthly basis, if not on a daily basis. If you're a large business, you have so many such activities. If you have to raise capital, if you have to buy a new asset, that's a capital expenditure. We have to understand how the business is doing, budgeting the business, growth of the business, so many scenarios. A business uses this financial modeling. And what is the financial modeling? How many of you recognize this person on the screen? Who do you think this is? Great. So that's right. This is Bill Gates. And why this is relevant today is not because of the picture, but more of what Amazon does. Now, Amazon, or even if you take Reliance Jio, does something called as predatory pricing. That is, what they do is they completely discount the products they sell. So immediately the next question you'll ask is, if supposing a product is heavily discounted, won't Amazon be making losses? The answer is absolutely right. Many market entrants, you take Reliance Jio, initially he gave out these Jio cards for free. But after 2 years, you start to realize the bill adds up, correct? So what they do is they penetrate into the market at very, very low prices called predatory pricing. And then over time, they recover that money. Now, how do they determine what discount they should give? How do they determine that? Financial modeling helps them determine where they take the health of the balance sheet today. They forecast, okay, if I put low value, over a period of time, my customers will triple. When my customers triple, I will break even. That is, I will go to a stage where I start making profit. So at a very, very basic business decision level, financial modeling plays a huge role. Now, do you need a very special software? Absolutely not. Your tools are Microsoft Excel. Most businesses, even the largest businesses, use only Excel today. So today, after this session, you yourself can go and make a financial model. That is how simple it is to derive or arrive at a financial model. Other softwares, of course, include your Oracle, SAP, but most businesses do not even use that. Who builds these models? Now, typically, if you are someone, you feel you like financial modeling, you want to go apply, then these are the roles for you. Primarily an investment banker, because he's often involved in making decision whether a company should buy out another company. So automatically, unless you value the company, you cannot buy it out. Equity research, by what they do, they value the stock of different companies. Credit rating agencies, due diligence, transaction advisory. So if you see the screen here, there are various roles. that are very specific to financial modeling, which if you apply for will only focus on financial modeling. Friends, I'm going to share with you this presentation. At the end of the session, I will give my email ID on the slide. You can note it down and take, because in 1 hour, we are not going to be able to cover all the slides in full depth. So you will have access to all these different companies and the rules. Just before our session today, I was very curious to see how many roles are there. And you'll be surprised to note that over 3,000 roles are available today in financial modeling. The reason being it's an upcoming field. Almost every other day in the newspaper, we read of mergers, we read of one company buying another company, acquisitions. So this role is extremely crucial. Which comes to a next question that many students ask. Ma'am, I'm not sure. I like the idea of financial modeling, but I'm not very sure if I directly want to go to a specialized role, whether I will like being an investment banker. Then this slide is the place for you, friends, where over and above those specific roles, these generic roles also deal with financial modeling. So as you can see, the entire role of financial modeling is extremely pervasive. It is not just limited to one specific role where you do it. If you're a finance manager of a company, you will end up doing financial managing. If you do a audit head, financial analyst, consulting, and all of these roles have very, very high prospective values. Now, when you see the salary split, automatically a lot of students say, okay, I want to become investment banker, highest salary. Now, that is not the case, especially at a formative stage where you're going to go pick your first job. Please remember. Can we have the participants mute, please? Okay, so since it's going to be your first job, only salary is not going to be a benchmark. Please remember, if you see here between a regular analyst who gets 5 lakhs, a senior analyst automatically gets 10 lakhs. So as you can see, when you're passionate about your role, when you like what you're doing, automatically salary increments arise. I urge all of you to decide on what your first job is going to be based on your interest in the profile. Now that you know what opportunities are there, what are the different financial models, let's come to a critical question of where do I start? I'm interested in financial modeling. How do I start? First and foremost is learning to read the financial statements, which I will take you through different tips and tricks in the course of this slide. For example, between the first 3 options, you should know how to pick the right option. That just doesn't come by looking at it. You need to apply various ratios. You need to understand some analytical skills in order to be able to interpret different balance sheets. And last, of course, once you've read the balance sheets, you need to do a ratio analysis. So first aspect, as I said, is understanding the business. Now, where do you look for this information? How many of you think you can download any company's financial statements, or do you think that you need to specifically go approach the company to understand their financial statements? How many of you think financial statements are readily available? You can say yes or no. Prabhat, I will give you my email ID at the end of the session. You can write to me. I will definitely share the slides. You do not have to take notes at this point of time. I just want all of you to focus and be interactive over the course of the session. So a lot of you are saying that financial statements are readily available. The answer is absolutely yes. The first step in understanding a company's financial model is going to be looking at the financial statements. You go to any website. I have shown Money Control here. There is a tab that says annual reports. You go type in any company, you will be able to download their annual report. So I urge all of you to do this. Even if you're going for an interview, go to these portals, download that company's balance sheet so that you are well prepared. You need to go through the annual report. It has all the information about the company that you will need to know. So as you can see, when you download the annual report, there'll be a financial statement. Usually in the end, you should go see the balance sheet, see the P&L and analyze it. Now, typically, once you download this information, you will have to forecast. So this financial statement is available till 31/3/20. For the purpose of financial modeling, you need to forecast 31/3/21, 22, 23, 24, 25. The next 5 years, you need to forecast how the sales is going to be. Now, a very common question is, how will I know whether I just increase it by 5%? Absolutely not. Very common interview question. Please remember, whenever you forecast from this balance sheet, you need to understand how the industry is moving, whether the previous year trends, on what basis the sales are increasing. Then specific to the company, where what their plans are. Now, naturally, when they say my sales is going to double, that means they should also buy that many more fixed assets, correct? They have to buy the plant and machinery to manufacture in order to be able to sell more. So it has to be a very scientific analysis as to how you are going to be forecasting in financial modeling. This is in fact the most critical component of financial modeling. What are the different financial models? You have a 3-statement model, discounted cash flow, budgeted forecast, option pricing. While these words, terminologies look complicated, they all do the same thing of forecasting from the existing balance sheet, the next 5 years profit and loss and balance sheet. All models have this in common thread. Now, I have a quick question before I explain these models to you. Will you receive 100 rupees today or 110 1 year from today? What will you receive today? What will you do? Whether you'll receive 100 today or you'll wait and receive 110 1 year from today. You can just type 100 or 110. Okay, so all of you have got it right, which is where the very critical concept of discounting comes, where whether 100 today is valuable or 100 and from today is more valuable. It depends on this discounting factor. When I do a forecasting, what I will effectively do is, today I will forecast the value 5 years from today, correct? For example, 31/3/22, I might say my sales will be 200 rupees. 31/3/23, I'll say it'll be 250 rupees. So naturally, when I'm arriving at the value of the business today, this 120 is what I forecasted. I need to discount it and bring it back to today, which is precisely what financial models do, especially this discounting cash flow method. What it does is, as you can see on the screen, it will forecast 5 years, the value, the profit, and then it will bring that entire value to today by using a discounting factor. How this discounting factor is arrived at is a very scientific formula which you would have read through, and also ample resources available online. So similarly, all your models, financial models, will have this forecast. You need to bring that value to today. Now, Niranjan, you've raised your hand. I will definitely answer all questions at the end of the session. I'll quickly finish explaining this and then we can sit on question and answers. When do you use discounted model? Now, naturally, friends, the most important criteria is going to be whether you're able to forecast the next few years value. Now, if it's a mature business, it'll be very easy for you to forecast the sales for the other years. So automatically, discounting cash flow method is a good way for you to analyze that. The next aspect is how predictable. Now, if it's a seasonal business, today there might be a sale of 2 lakh. Tomorrow or next year, it can go down to 10,000. In such scenarios, it will be very difficult for you to use this method. Why I picked DCF specifically is it's the most common method, especially in interviews for financial modeling. Your interviewer is going to ask, take me through one model. I fully recommend for you to take them through DCF model, because one, it's easy to explain. Two, you've already studied it. So for you to arrive at a model is going to be very simple. Now, over and above those models that we went through, there are certain other models. As you can see here, the other kinds will be consolidation model, leverage buyout, initial public offering, and merger model. To quickly take you through what consolidation model is. Now, in a scenario where you're just doing one business, it is going to be easy. But most of the conglomerates, they have various brands within their main brand. For example, if you take this Yum brand, it has KFC, Pizza Hut, Taco Bell, Burger Grill. So it has 4 brands. How will you value that? Do you take all 4 together and do a forecast? The answer is no. What you do, each of these sub-businesses, you will value separately. You will take KFC balance sheet, do a valuation. Pizza Hut balance sheet, do a valuation. And then you will merge the final value together to arrive at your overall value of the business. Similarly, the next model, leverage buyout model. Very, very common interview question. What is a leverage buyout? Let's take a scenario where there is Reliance that is going on. Reliance is not doing well. It is looking to sell. I'm Divya. I'm very interested to buy the business, but I do not have any money equivalent to what I need to buy Reliance. So what I do in such situations, I go to the bank, I take a loan. I take a loan saying Reliance asset is very high. I'm going to use this loan to buy out Reliance. So you keep that asset as your security. The bank will give me money. I will buy out Reliance through a loan. That's why it's called leverage buyout. And then I'm confident in 3 years I make Reliance profitable. I earn enough money back and I repay the bank. Very common model, especially when you want to acquire a foreign brand. For example, Tata acquired Tetley, the tea brand, through leverage buyout. The next model, most popular, common, is your merger model, where every other day in the newspaper, many companies are either merging, buying out, or becoming one company. But what if I were to tell you, just because you merge, it doesn't necessarily mean you're going to be successful. All of us have owned this phone that we see on the screen, the Nokia. What happened today? Today, none of our hands, we are using Nokia. It rose to the highest degree and suddenly slumped. What happened? Why did Nokia fail? First and foremost, they didn't adapt their technology. Now, most of us think that is the reason why they didn't do well. That is not the only reason, friends. At that point in time, when Nokia was not doing well, Microsoft, Bill Gates took a very, very wrong decision of acquiring Nokia. That is, it funded Nokia and it acquired Nokia, thinking that by merging, it will revive Nokia and Nokia will become a household name again. This merger was extremely unfortunate. The reason was Microsoft itself was not doing well at that point in time. By merging with another company that also needed heavy revival, it did not pan out. Microsoft thought by merging with Nokia, Nokia has a great brand name. But only after merger, they realized Nokia did not have that much of a brand power to revive in the market. So multiple times, there can be scenarios where you do a wrong merger and it ultimately fails for both the brands, where ultimately Microsoft landed up closing down many of Nokia factories and recovering money through that process. The next is there's Netflix, and then there's something called Blockbuster. How many of you, what does this Blockbuster do? Has anyone heard of this brand? If so, you can type on the chat box. What do you think Blockbuster does? All of us know Netflix. I'm sure all of us are watching Netflix every other day. How many of you know Blockbuster? What do you think Blockbuster did? What is Blockbuster into? Which business? Absolutely. Good answer, Ankit. So Blockbuster was very similar to what Netflix did, except it was doing in-person stores. In fact, friends, at one point of time, Netflix approached Blockbuster and begged them to buy them out, because Netflix, when it started, it was not doing well. Blockbuster was the market leader, where they rented out DVDs, video cassettes in person. They had over 3,000 units across the world with Blockbuster stores. However, when Netflix went and asked Blockbuster to merge, they laughed at Netflix and said, "You are too small. Please do not enter." So what Netflix did is went out, captured the market. Eventually, Blockbuster, even though it got major funding from Viacom, it could not survive, because increasingly many people started going to online mode. Blockbuster was still between brick and mortar. Then after 2-3 years, they came to online, but it was too late. So it is a perfect example of too little, too late, where at a time at which it should have merged, it did not merge. And because of that one wrong decision, where it thought it can be on its own and still lead the market, it landed up shutting down more than 9,000 stores. And today there is just one store. So please remember, there are business failures where you make a wrong merger. There are failures of business when you do not merge at all. So it is extremely important when you do financial modeling for you to understand the different mergers. For example, if you see on the screen, horizontal merger is when you do the same activity and you merge between 2-3 companies. Vertical merger is when, if you take an automobile industry, one person might be doing a light, headlamp of the car, brake of the car. If they merge together, it is different stages of production, but the same final product. Then there's concentric merger, where you have the same customer, but different products. So various kinds of mergers. Quickly, can you tell me what merger is this? This is between the three banks. What is this merger called? Between three banks, I've once again shown you the different types of mergers. Three banks merging together is which model? Anyone? Absolutely right. It is a horizontal merger. So when this is a very, very common form of merger, especially in the finance institutions, where in order to achieve efficiency in operations, they merge together. Now we all know Walmart acquired Flipkart for a high value. What merger is this? Walmart acquiring Flipkart. I'm going to wait for a few answers. What merger you think it is? So one Govinda says vertical. Anyone else? Okay, vertical. Prabhat says concentric. Ankit says market extension. Anyone else? Okay, so please note that this is a concentric merger where they have the same customer but different products. How is it different? First and foremost, Flipkart was online, while Walmart was mostly in-person brick and mortar. So the reason for this merger was a concentric merger where they could pose a real competition to Amazon and cover more parts of the market. So please remember, knowing the different types of mergers is extremely important, which brings us to a critical aspect of our session today as to what do you do while preparing for your interview for this financial modeling role. First and foremost, ensure you go to the interview on time, work on your resume. I think this might sound very generic, friends, but resume is going to be a blueprint. Before you enter into the interview, they're going to go through your resume. So it's very, very important you build your resume correctly. If you're going for a financial model role, ensure you're doing some certificate courses this 1 month you have before your campus placement starts. So please update your resume and ensure that it is different from somebody else's. It cannot be just a copy paste. We often notice people who come for the interview together, their resume is the same except for name change. Please ensure you avoid all of those aspects. Second is, whenever they ask you a question in financial modeling, I've already asked you some questions over the course of this session. Always take 30 seconds to a minute. And if you feel that the employer is impatient, then you repeat the question. It will give you some time. You reword and repeat the question, then you'll be able to answer, oh, the merger between Flipkart and Walmart it gives you that 20 seconds to recoup and find out the answer. Third most important aspect, any interview, have a structure to your answers. The three most important points are the three different models of financial modeling. Always ensure you're specific and you give the 3 or 4 options. They do not expect you to reproduce definitions. You are not expected to recite anything verbatim. So please ensure that you have the answers ready. Now, I have compiled different questions that can be asked through the course of your interview. As I already said, you can email me. Today's session, I'm going to take time out to explain the different concepts to equip you. You can always go through these different questions and prepare suitably. Which brings me to one question that I want to quickly take you through. What is the difference between valuation and pricing? Does anyone want to attempt that in the chat box? What is the difference between valuation and pricing? Now, I've told multiple times, you have to value this company. You have to use financial models to value, use discounting model, 3-statement model. We've gone through a lot of valuation aspects. How is it different from pricing? Are they both the same? You can just say yes or no. Is valuation pricing the same, or is there a difference? So Govinda says it's not the same. A lot of you are saying it's not the same. Well, how is it not the same? So while that is the correct answer, it is different. Why is it different? So please remember, whenever you price something, it is based on demand and supply, right? If the demand is huge, supply is less, it's priced higher. But valuation is different, where you don't just look at demand and supply. You look at the overall company. You look at the assets, you look at the liability, and then you give it a value. Or it could also be a scenario where you see a perceived value, where you think in the future it will do well, so it is valued highly today. Which brings me to the next aspect. We all know Uber, right? All of us use it, we have the app. We also know from reading the papers that consistently Uber makes loss on a year-on-year basis. But why do people invest in it? It is very important to understand this is because the value they perceive for it. While the price of the Uber financials today is loss making, it is negative. Investors feel it is a novel method, it is going to give you value. So whenever someone buys this Uber, friends, they do not look at the balance sheet today. They see the balance sheet today correlated to their forecasted financial model. They forecast the 5 years, they feel there is growth. They look at the investor sentiment, they see how well the share price is growing, and in that method, they value it and see a value. Which brings us to the last part of today's session. I'm going to keep 15 minutes to just answer your questions, so I'd request you to be patient, which is ratios. Now, why do you need ratios? Now, there are multiple scenarios where in financial modeling, you might not have time to forecast, correct? Let's take a scenario, you want to buy shares. Let's take a scenario, a company in which you're working in wants to get some share capital. Now, they might not have the time to do a discounted cash flow method where they have to forecast 5 years. So in those scenarios, ratios are an excellent indicator, especially if you are someone in an equity research role, or if you want to become an investment banker. Ratio analysis will quickly give you a flavor of how well the company is doing or if it's headed in the right direction. Now, naturally, I think whenever we discuss ratio analysis, there is one common question. Why can't we just see if it's profitable, right? Within a company, you can just check last year to this year. If it's doing better, obviously it's going to do well. Your answer is absolutely right. If you are comparing within the same company itself, then you can do a year-on-year analysis and do a trend analysis. But what if it's a scenario where today you're a small tea company and you want to compare the Tata tea, you want to compare the Tetley tea. In those scenarios, your volumes are going to be different. So obviously the profit you earn will be nothing compared to the profit they earn. So that's when ratios truly come to use, where you compare different companies of different sizes through a common measure and metric called as ratios. Very, very commonly used in financial modeling. We all know the most popular ratio is going to be a gross profit margin ratio. All of us have done it. It is nothing but you take your profit and loss account, gross profit by sales is going to give you a gross profit margin. Higher the gross profit ratio, better. The next is net profit ratio, where you divide net profit by sales into 100. Now, in this scenario, friends, I want to ask you a quick question, right? You see different years and you see these ratios. Which will you pick? Whether you will pick a company which has a higher gross profit ratio, or whether you will pick a company which has a higher net profit ratio. Which one will you pick? Now you take between year 1 and year 2. Gross profit ratio is the same, or we'll take between this year and this year. Any year, okay? My question is going to be whether you will pick a company with high gross profit ratio or a high net profit ratio. You can just say gross profit or net profit. So some Tirod has said, Prabhat has said net profit. Anyone else? Net profit. A lot of you have said net profit. Friends, this is where I want to correct you. We always pick a company with a higher gross profit ratio. Correct, Disha. The reason being, gross profit will indicate what is gross profit? Sales minus cost directly attributed to sale, which means without those costs, you cannot make the sale. Okay, so you know for a fact that gross profit is non-negotiable. That means whatever direct cost you have to incur it to sell your product. But whereas when you look at net profit, you have many indirect costs which are more discretionary in nature. So between gross profit and net profit, you will always go for a higher gross profit ratio. Now, naturally, if your gross profit is the same and you have net profit, you'll go for year 2 because it has a higher net profit ratio. The last ratio which you look at P&L level as a broad level main ratio is going to be your interest cost. Now we know many companies borrow. Just because they have interest cost in that profit and loss account does not mean that the company is doing something wrong. It is very normal for businesses to get loans to have interest. But how do you know what interest cost is correct? Now, in a scenario where I'm making 10 rupees as my interest cost, my net profit has to be 30. That means my net profit has to be 3 times the interest cost I spent. As long as it is within that bracket, then it is a good aspect. But the event where my interest cost is 20, my net profit is 30, then it is something to worry, where the company has to necessarily reduce their borrowings to show a healthy balance sheet. So every ratio you have a benchmark, friends. The next is going to be a balance sheet ratio. All of us have seen current ratio, where we say that current ratio is the ideal current ratio is 2:1. That is your current asset divided by current liability. I'm not going to go into the formula because I'm sure all of you have studied it during your costing. Now, can someone tell me a high current ratio? Now we say at a minimum, your current ratio has to be 2:1. That is your current assets has to be twice as your current liability. Let's take a scenario where your current assets is 4 times your current liabilities. Is it good or is it bad? A high current ratio where it is 4 times. You recommend 2:1. You say minimum, it has to be 2:1. So Prabhat says bad. For those who are saying bad, why is it bad? Why is it bad? Niranjan, Ankit, Amrita, a lot of you are saying bad. Why do you think it's bad? Absolutely right. So if you have high current assets, that means your inventory is very high, correct? Your debtor is very high. Your cash in bank is very high. What does it mean? You are blocking your capital. That is with high inventory, which is more than 4 times. You do not need to store so much inventory. You could have used that money to go acquire another business or to put in a good investment. So please note, when we see ratios, whatever is recommended is what it should be. If it's higher, it does not automatically make it better. It only means that there is some mishap that is happening where it is not being channelized correctly and the garb of showing a high ratio. So across industries, this is a good benchmark, what you see on the screen. So these are indicators. Today, if you feel you want to go buy shares of a company, you quickly do these ratios and see if it is meeting the criteria of a healthy balance sheet. The last ratio I want to cover today are the ratios which link your balance sheet and P&L. Very, very common. It is called as a price earning ratio. Now, any investor, any financial modeling role will ask you about the ratio. To simply put it into understanding terms, what happens is you take the profit after tax, you divide it by the number of shares. That will give you the earning per share. What does it mean? When a company is earning so much profit, you divide it by the total shares. So one share, how much you earned, is what is called as an earning per share ratio. Now, from that earning per share, you go into NSE or BSE and check the market price. What is market price? The price at which one share of the company is being sold in the market, which will give you the market price. When you divide this market price by the earning per share, you will get something called as a PE ratio, price earning ratio. All of you have studied it. Why am I covering it? What it actually means is, for every rupee, if you take here, an investor is willing to pay 59 rupees, which means while your actual book value of the share is going to be 1 rupee, your investor is saying, don't worry, I'm going to pay 59 rupees, which is why people say a high PE ratio means that share is good, because investors are seeing value. For every 1 rupee, I'm paying 59 rupees, which means that is the 50 times of values what the investor is seeing in the company. Whenever you look at a financial modeling, you look at investing, this ratio is mandatory because it will actually show you what the rate, how the investors perceive the company. Okay, so naturally, which comes up to the more softer aspects of this session of how a good financial model should be. It has to be easy to read. It has to be simple. It has to be accurate. Whatever analysis you're making, whatever assumptions you're saying, supposing you're saying sales is going to increase by 20%, you need to have a reasoning for it as to why you feel it is increased. It has to be backed by how industry is doing, how the investors are seeing, PV ratio, so on and so forth. Now, friends, as I already said, if you are someone who is interested in this session, you feel you want to take up a role in financial modeling, either through the niche or the first slide where I showed you the different specific roles, or through a regular role. Now, tomorrow, if you go to the interview and say, I like financial modeling, that is not enough. So before you attend these interviews for these specific roles, it's very important that you go through these different courses. Now, most courses are available for free. You take up Udemy, Coursera, many courses in financial modeling is available, or YouTube. Go understand it, add it to your resume of you acquiring these certifications, because automatically, when a person who goes without any experience, without having any background, versus your resume, which will carry certifications or different more skills that you've acquired to understand the same role, you will be preferred over the other candidate. I always encourage everybody to do a lot of upskilling. Before I conclude today's session, I want to run through a very basic aspect. Now, which is better? Whether debt is better or equity. For example, whether you want to give loan to a company or whether you want to take shares of a company. What do you think is better, loan or shares? Anyone? So Kirot says loan, and you need to tell me why you think you prefer a loan. Shares, a lot of people. Okay, so please remember, friends, there is no straightforward answer. In fact, if your interviewer is going to ask which is better, debt or equity, you need to ask him, is the company profitable, right? Because if the company is profitable and if you feel that it is going to be safe for you to get your investment back, you will go through the equity. Why? Because if it's profitable, the chances are tomorrow, like how you saw the price earning ratio, it is only going to be doing better. So if it's consistently profitable, if it is growing, equity would be a better option. But in the event where you are not sure, the event where you feel that the company is not doing so well, or you feel suddenly this year is profitable, but if suddenly another COVID wave comes, it might not do well, then debt is a better option, because one, you are assured of your return in the form of interest and on your final payment. So in the event where the company does not repay you, there are various recourses. Whereas when you take equity, it's a risk versus reward aspect. Now from the company's angle, which is going to be better, whether it has to raise equity or whether it has to raise debt. Again, the question lies on how well it is going to be doing. When it takes a loan, if it's profitable, it will pay interest. So it can take tax deduction on that interest. It will be able to repay because it is profitable. Supposing it's loss making, like if you take Uber, naturally it is making a lot of loss. It is going to be very difficult for Uber to be making interest payments over and above that loss. It is also not going to help it. So automatically it is going to raise funds in the market in the form of equity. So these aspects are very important. That's why from an investor angle, when you give a loan, you feel you are assured. It is very stable. You're assured of a return. Then what happened in the case of Franklin Templeton? Now, Franklin Templeton, just last year, for those who read the news, it invested in debt funds, which completely crashed. What is debt funds? Basically, I'm not sure which company is doing well. So I tell Franklin, I'll give you money. You go give it as loan to different companies. And whatever interest you get, you give it to me as payment, right? So these are debt funds where the fund manager takes your money, takes many people's money, accumulates it and gives it as a loan. How will it crash? I've just told you debt is very safe because you get interest repayment, you get loan repayment. Now, specifically in Franklin Templeton's case, what it did was it took everybody's money. It said it's extremely safe. It is going to put in debt funds. And don't worry, you will get 15, 16%. Now, automatically, you're very tempted because when you get 16% interest every month, if you go give it to a regular bank and fix a deposit, you get only 5%. You know, debt fund is safe. You're getting 16% interest. So you give all your money to Franklin. But during COVID, what happened was Franklin took your money, invested in very risky companies, where even though it's debt fund, it did not have an assured return. The reason being, those companies themselves were not doing well. So they could not go approach the bank because the bank said, we are not giving you loan. So they started coming to people like Franklin, taking the money and saying, I'll give high interest, don't worry. But ultimately, when COVID happened, they were not only able to pay that interest, they were also not able to repay the loan. So just because you go and invest in a debt fund of a company doesn't automatically mean it is safe. You have to always look into the pros and cons. Even if you're the finance manager of the company, if someone is going to come and ask, should we raise debt or equity? You'll never be able to give a straightforward answer and say debt or equity. You should look into the specificities of your balance sheet and then accordingly analyze, do a financial modeling, and then give your advice. Please remember, very common question, debt or equity. Ensure you give reasoning. If you're saying debt, give these reasoning, say it's a stable company, say you're confident of repayment, and then give your answers. Now that we've finished the session, I think I've covered almost everything about financial modeling. We still have 10 minutes left to take up your questions. As you can see, I've given you my email ID. For all those who want to go through, I have a very detailed PPT that I had prepared earlier for this campus placement. So please write to me and I'll share it with you for you to go through it before you attend interviews. With that, I'd like to thank the Institute for having me here today. It's such a pleasure to address a brilliant crowd such as you all. I think almost all of you got answers right, which shows you're already 80% there to attend your interviews. Enjoy, you prepare well, study hard, and do very well. Thank you so much. I'll keep my email ID on for those who want to take it. And whoever has questions, you can either unmute yourselves or you can type it on the chat box and I'll definitely take it up and give my answers to you. Thank you, Dharmendra.
Anybody has any questions? May please ask. Either through in chat box or through audio.
Yeah. Thank you. Thanks, Amrita, Loknath. You can ask me any questions. It need not be specific to financial modeling. I'm happy to answer. Thanks, Kirot. Very kind of all of you to thank and appreciate. Thank you so much. Thanks, Deepak, Mihir, Anisha. Prakash Kumar, you can unmute or you can just type a question, whichever is fine. Thanks, Anjit, Leepika. So Saroj has a question. Is project report similar to financial modeling? Yes, it is similar, but project report will be more specific for one event. It won't be a scenario where you'll value the entire company. It'll be a financial modeling specific to that project where you'll assess how much income you foresee to earn, what are your expenses going to be, and then you arrive at the value or at the profitability of the project. Prabhat needs explanation on financial modeling. And so Prabhat, to tell you in very simple term, it's a tool for analyzing, right? So we use Excel or different models that I took you through. For example, I spoke about discounting cash flow. It's effectively where you forecast the revenues and the profitability of an enterprise and arrive at the value today using a discounting factor. Thank you, Balram, Bera. Do we have any other questions for today? Thanks, Parameshwar. Does financial modeling follow Ind AS? So, Saroj, it depends on the company you want to do financial modeling for. For example, if you're doing financial modeling of a company which already follows Ind AS, then automatically whatever you forecast has to be in lines with that. If it's for a regular company where Ind AS is not applicable, then you do not need to follow it. You can just use your Schedule 3 of Companies Act. It is similar. It is valuation, Prabhat. We need to have proper stock for analyzing any of the. So, Jyoti, absolutely not. If you were able to answer questions today and understand the concepts, that's more than enough. You do not need to know the value of which stock, how much Britannia is selling for, how much ITC is selling for. You're not expected to know at all. So, Loknath, to arrive at the discount rate, as I took you through this session, it will require a separate session because you have a very specific formula where you take the risk-free rate and you add premium, market premium into beta. You should go through the slides. I have done a problem where you applied this, but it's very, very specific to arrive at for each industry. So Dharmendra Sahu, how is it different from financial planning analysis? So financial planning and analysis will be using the current data. You do not do a forecast in financial planning and analysis. That's why even a financial analyst uses financial modeling, because you will land up needing to forecast and having a financial model even to determine small things such as price of your product and sustainability in the market. Saroj, bailout modeling is nothing but a leverage buyout. What I told you, where you take a loan to buy out another company, that's called bailing out a company which is not doing well, and you do not have funds, but you use somebody else's fund to bail them out.
Hello, ma'am.
Yeah.
Ma'am, in a span of 1 month, like we are having right now, so which course do you prefer we shall take so that we can complete in this short span?
So I think the course you take is going to be very dependent on your area of interest. Now, if you are someone who feels you like financial modeling, then you can take specific courses for it. Friends, what you need to remember is once you have your professional degree, you no longer need to accumulate degrees for the sake of it, but the courses you do need to have your interest in them. If you, for example, you have CFA, you have CPA, you have various courses, right? MBA, so many things, so many certifications. So pick what you think you are strong in, what you're passionate about, and build it up from there. So that even when you attend the interview on those specific roles, you'll be able to have the expertise of also attending additional courses and adding it to your profile. What are the specific area or subjects in general we need to cover for these posts? So I think, Jyoti, very similar to, I think, Avinash's question. I think what you need to do is determine what your area of interest is. For example, you will know what companies are coming for campus placement. You will know the roles that are available to you to apply for. So according to that, the courses are plenty. So you will need to narrow it down further. If you're not sure, ma'am, I have no idea what I like, then go do 2-3 certification courses and see which one is of your interest. They're fairly straightforward, friends. 6 to 8 hours is all you need to finish one. So try to see a lot of YouTube videos. Everything is available on Google today. So it's not going to be too difficult. Govindraju, to your question as to how financial models are different from MIS. MIS is a monthly information statement that you prepare on a current date basis. You do not include futuristic values. In financial modeling, you estimate and use a futuristic value. So both of them are completely different. Any other questions? So Saroj, to your question of project management, yes, like I said, go Google. You will have a host of courses. If you're not able to find, you can email me and I can always suggest good courses for you. Govindraju, yes, financial modeling is futuristic in nature. Saroj, my email ID is on the screen. You should be able to take it. It's divyasukumar.in@gmail.com. I've also typed it out. Parameshwari, to increase your knowledge, the best ways to learn more, read more, go to Udemy, go to Coursera. There are multiple financial modeling courses. In fact, if you just YouTube how to build a financial model, there's a detailed 40-minute video on just how to build a financial model. So that could be a good starting point for you. So I think all questions have been answered. If you have any other questions, please feel free to write to me. I'm always available and I will definitely respond to your queries. I'll also share this detailed PPT with you and the branch for them to use it when it's required. Thank you so much to the Institute for again having me here today. It's been an absolute honor and privilege to address this very intelligent crowd. And thank you so much. Yes, sir. Back to you.
Thank you, madam, for your nice deliberation and interacting with the students. Definitely, this will be increase definitely this will boost their before attending the interview. And
thank you, sir.
I convey my gratitude on behalf of the Untitled Chapter of Cost Accountants for accepting our invitation and deliberating the students and interacting also. And I definitely will take Madam help in future in other program. And I convey my special thanks to the students, those who have supported and keep their commitment to attend the program. Almost all have been attended the program. Thank you, Madam.
Thank you.
This, I hereby declare the closure of the webinar. All the best to all the students. Thank you, Madam.
Thank you, sir.